Saurabh Mukherjea joins us. Saurabh, it's the first time we are connecting in this year. So let me start with extending best wishes to you, your team, and your family for 2022.
Thank you. Thanks a lot. Happy New Year to all the PT News viewers as well.
Saurabh, 2021 was a easy year to invest. As long as you bought stock, it didn't matter which category you bought. Barring few names, 80% of the market obliged in 2021. Do you think 2022 will be easy, difficult, or challenging?
Look, Nikunj, I think honestly, I'll say every year has its challenges and every year brings its opportunities. And to that extent, I think 2022 will be no different. The challenges are reasonably evident. We will get more waves of COVID. I think that's something we've all learned to live with, and we'll get even more accustomed to dealing with waves of COVID. There'll also be challenges from further supply side scarcities. Whether the semiconductor squeeze might pass, but surely there will be other supply side scarcities given the pace of the global recovery. But whether opportunities will be evident, the opportunities will allow you and me to make money, is the economic recovery further gathering pace the world over, whether it is recovery in the Western world and the related demand for tech-oriented companies in our country to cater to the West's need for breakneck digitization on the Fortune 500 companies' part, or whether it is a Capex revival in our country. So there will be opportunities in terms of making money from this global revival, and we need to be awake and alive to that whilst dealing with the issues arising from supply side scarcities and the attendant COVID challenges.
How should one understand the supply side challenges and the impact of that on margins and companies and performance? Because supply side challenges are here. COVID restrictions, you don't know how long they would continue, but they will cause disruption. So what is your understanding of this entire supply side challenge?
So look, I think in a way, if you ask me, the biggest lingering impact of COVID will turn out to be not so much the overall impact on economic activity, because as all of us are learning, we're learning to deal with these waves. So what COVID does is each mini disruption throws the broader supply chain out of gear. And even if you disrupt one link of the supply chain, it creates bottlenecks elsewhere in the supply chain, right? It's almost like COVID in that regard is a perfect disruptor of supply chains on an ongoing basis. And what we are seeing is companies with stronger balance sheets, with greater logistical strength, they're basically hoarding up on inventory. They're hoarding up on raw materials. They're hoarding up on inventory. They're pushing more goods into their wholesalers and distributors' warehouses, just in case the next wave of COVID comes sooner rather than later. And what that will do, Nikunj, I think over the course of the next 1 or 2 years, we will see further pressure on smaller companies who don't have that sort of balance sheet might, who don't have that sort of supply chain might. The larger companies do, and therefore the polarization in market shares across sectors, across products will become more pronounced. We saw some of this in the last 6 months, and we saw how a Pidilite, how an Asian Paints, how a Titan, in the case of IT services, how a TCS has dealt with these disruptions far better than the weaker competitors. My reckoning is over the next 1 or 2 years, this trend will become more pronounced. Smaller companies will find it much harder to deal with the supply chain disruptions.
Saurabh, before we go forward, I want to take the clock back and talk about we've got your views, and we've discussed your views on the fintech companies. But apart from fintech companies, there were a lot of IPOs which went public yesterday, and the count is at 60. There were 60 companies which went public, which is a combination of defense companies, few chemical companies, and few fintech companies. Anything which is on your radar or anything which has become part of your portfolio out of the new 60 companies which listed last year?
So look, I mean, typically in our country, in each wave of IPOs, around 10%, 1 in 10 go on to be long-term value creators. And our sort of study of the crop of 2021 is that there are some good names. We are doing research on a couple of them. Hopefully, that research will culminate over the next month or so, and we'll start building positions. What I can say at this juncture is the companies that are looking really good to us from the class of 2021 have very little to do with the sort of tech craze that's taken hold in our country. They are high quality small and mid cap companies with what we at Marcellus tend to like, which is building a great franchise, generating strong cash flows, delivering a product that people need, and building monopolistic positions of market power. So the class of 2021 has some good names. We are looking at them. We're hoping to conclude our research over the next month or so and start building positions. But what I can say at this stage is none of them have the sort of the tech craze associated with them.
Saurabh, just picking up, from the point that you always make when it comes to great franchises, and you study the new ones that have edited the Lal Street. Always betting on a good franchise may not get you the returns. Look at HDFC Group, for example, and what happened in 2021. So where does that then leave your theory?
Right. So if you look at any good portfolio anywhere in the world, if you take a high quality portfolio of say a dozen and a half stocks, what you'll see, Aisha, is that in a typical year, a third of the portfolio will blaze away, right, in terms of share price performance. Another third of the portfolio will have an all right year. It'll perform broadly in line with the market indices. And around a third of the portfolio will have a quiet year in terms of share price compounding. And a fund manager's job is not to lose too much sleep about any of these three pieces, right? The one third that's blazing away, don't get too excited about it. And the one third that where the share price action is muted, don't lose sleep about it. Focus on the underlying business. Focus on the dhanda, as we say it in Hindi, and see whether the business continues to grow at a good pace. As long as the business continues to grow at a good pace, it's not, in a way, paradoxically, it's not my job or my colleagues' job to jump up and down about the share price. The share price inevitably follows. If you were to take HDFC, if you look at HDFC's 3-year, 5-year, 10-year, 20-year returns, they have faithfully tracked HDFC's book value per share. There's obviously volatility. So, for example, when ILFS happened, there was a needless volatility in HDFC Bank shares. But our job is to look through that and focus on the underlying franchise, the compounding in book value per share, which continues to be pretty healthy in HDFC Bank's case, or for that matter, in Kotak Bank's case or Bajaj Finance's case. And hence, we stay invested and keep our eye on the ball being the underlying business, the ball not being the share price. The fund manager's job is not to stare at the share price and jump up and down, reacting to the share price.
Okay, so focus on the dhanda. Now, can you tell us that when they're focusing on the dhanda, are there any stocks that are on chutti and need to get back to school?
No, so I think thankfully, partly because of the post-COVID recovery and partly because of the hard work that my colleagues do, the businesses that we've invested in, the business is booming. And I say this in all seriousness, I haven't seen this sort of broad-based business booms in India for the last decade or so. Not just in terms of current economic activity, but what I'm hearing from our investee companies, CEOs, in terms of their economic expansion plans, their business expansion plans over the next 1 or 2 years, both new capacity being installed, further acquisitions being done. This is probably the most bullish I have seen corporate India be for the last decade or so. And that's why, to be honest, even more than usual, our focus on the share price is relatively low. The focus is on how much can you grow your business. We have invested in you. How much can you grow your business over the next 1 or 2 years while generating free cash flow? So 3 sectors where I'm seeing very elevated levels of boardroom aggression. One is the sector we were discussing 2 minutes back, lenders. High quality lenders have realized that the weaker lenders are falling by the wayside. Pretty much every month brings news of a private sector lender falling by the wayside. And obviously the stronger lenders are licking their chops at the prospect of further market share gains in an economic recovery. The second sector is IT services, where the smaller players are finding it hard to recruit people. They have staff shortages. the larger players like TCS in our portfolio don't have staff shortages and hence are grinding out 15% dollar growth year on year. And the third area which we've discussed on your channel for a couple of years now, specialty chemicals, huge demands, lack of supply-demand mismatch in specialty chemicals, and the stronger players therefore investing relentlessly in capacity expansion and trying to capture the economic upcycle.
Right. Saurabh, you're known for contra calls, and I recall about a year back when you said that Reliance is something that you will completely keep out of your portfolio. All of us had raised our eyebrows. Perhaps that call has gotten right, because in the last few months, Reliance has done really nothing in the market. But I want to know, what's your big contra call? Either a stock to avoid or to buy for 2022, which no one's currently looking at, or is it's completely against the tide?
And look, I mean, whilst it's very nice of you to give me credit for a few things, but all fairness, we've been saying for the last year and a half that high quality lenders will do well. And I was just looking at it when you guys were opening the show. Bank Nifty is only up 17%, whereas the broader markets are up 24-25% over the last 12 months. So Bank Nifty and in general, high quality lenders have underperformed this rally. And therefore, if you ask me, our big call for this year is that there will be upside, significant upside in loading up on good lenders, but more generally high quality financial services companies. So for example, moving beyond the lenders, we have a large holding in HDFC Life in some of our portfolios. We also have ICICI Lombard. Both stocks have had muted share price action, and our reckoning is these franchises are way more valuable than the stock market currently sees them to be. Both in HDFC Life and life insurance and ICICI Lombard in general insurance, to our mind, stand head and shoulders above the rest of the market. I'm not 100% sure whether the Indian stock market has yet figured out how to value life insurance and general insurance. They tend to value, a lot of analysts tend to value life insurance almost like a mutual fund house, which obviously to my mind doesn't make sense. It's a very different skill set. But my reckoning is over the next 1 to 2 years, high quality financials, whether it be HDFC Bank, Kotak Bank, Bajaj Finance, and Aavas financiers, moving on to HDFC Life, ICICI Lombard, I think we've got a good outlook in an economic recovery. Strong financial services companies, I think, will do well. So that I would say is our contra call, the whole gamut of quality financials, giving your viewers good returns over the next couple of years. And I have to hold my head up and say, we said this a year ago, it hasn't quite worked out in the last 12 months. But as I said, our focus is on the dhanda, not on the share price. And we reckon the dhanda is flourishing quite nicely.
Okay, time will tell how that call pans out. I'm curious to know, Saurabh, what does a traditional investor like you think about Bitcoin, NFTs, etc.?
Honestly, because we are traditional, a big part of us doesn't understand the craze. But to the extent we understand it, our reckoning is it's something that people should do as a hobby. To our mind, given the murkiness around it, murkiness not just from a regulatory perspective, murkiness not just because both the RBI and the government of India is repeatedly warning investors about these investments, but also it's murkiness from the perspective of the wrong color of money globally being drawn to this. It's relatively clear that the wrong color of money globally is getting drawn to this craze. I would say you can consider it as a hobby, but it'll be imprudent to make it a mainstream investment. But that could well be because we don't understand the subject fully. We're quite happy investing in conventional high quality franchises and compounding our clients' wealth at around 25% a year.
So, why do you like insurance? They've gone through a tough time. COVID has been difficult for insurance companies, and then on top of that, you got you got one LIC issue which would change the dynamics of the entire sector.
So 3 reasons, Nikunj. Firstly, much like in public sector banking versus private sector banking, it's relatively clear both in life and in general insurance. A very similar dynamic has played out and will continue to play out, which is the public sector ceding market share relentlessly to the private sector. So in public sector banks, we've seen over the last 20 years how systematic the value decimation has been. And the private sector banks obviously have been beneficiaries. A very similar dynamic will hold out, we reckon, for HDFC Life or for an ICICI Lombard, dealing with weaker public sector players who cede market share hand over fist every year. The second dynamic is, and we got to credit this to the great Warren Buffett, it's relatively clear that the float that he talks about benefits Indian insurers immensely, right? Globally, insurers get a float. But if you have a float in a country where you can make money in the bond market, in the stock market, the float is that much more powerful for you. So in effect, any well-run insurance business gets money from the insured customer, and they can use that money to create upside for themselves. Good quality insurers in our country like HDFC Life and ILOM do that excellently. And because returns in our country from financial investments are pretty good, their shareholders like us benefit from that float quite disproportionately. And the third area is the sheer lack of penetration. Barely half of Indians have general insurance products, right? Something like 50-60% of drivers in our country drive without insurance. Barely 1 in 2 of people in your and my socioeconomic strata are properly insured on the health insurance front. So lack of penetration, free float, and a construct where still a poor country, you've got a 10 to 20 year growth runway for high quality insurers. Makes us very positively inclined to these stocks. The fact that they're out of fashion today, we don't lose that much sleep on. Our focus remains on, are these businesses run well? Can they make money for our clients? And our answer is an emphatic yes.
I'm just going to wrap today's discussion with a thought on ESG, Saurabh. Do you think somewhere this entire excitement about re-rating ESG compliant companies and de-rating non-ESG compliant companies is overdone? Do you see a mean reversion happening there? Because markets go through these phases. We saw a mean reversion in PSU banks last year, textile stocks last year, value stocks last year. Do you think on the ESG front also similar could happen?
I think there's two ways to see this. Clearly, ESG as a theme, I don't think will go away for good reason. Not only our foreign endowment clients, but also our domestic high net worth clients want us to invest in clean businesses which are doing the right thing for the country, for society. I don't think that aspect is going to go away. Where I think there's an element of misguided investment around ESG is there's a big element of greenwashing, and companies which by no stretch of the imagination have got the E or the S or the G are presenting themselves as such. And so far, the market is buying their story. So, for example, companies where we know the accounts are cooked are presenting themselves as ESG plays, and the market is buying the story. I think that's where, Nikunj, over the next 1 or 2 years, there'll be a greater degree of discernment around who are the imposters, which companies are the imposters in the ESG story, and who are the real McCoys, who are the genuine ESG plays. So I think the theme stays, but a greater degree of discernment arrives onto the stage over the next couple of years, and you separate the men from the boys, the women from the girls.
Right. Saurabh, I'm just wondering, very quickly in a yes and no, do you have any sugar stocks in your portfolio?
Wait.
Okay, then you may want to watch our next up discussion. Good to have you in the show as always. I'm going to let you go on that note. Sugar stocks clearly